In this video, we're going to discuss how you can improve on the wheel strategy to protect yourself a great deal in this elevated kind of bull market that we're dealing with. At the time of this recording, the market is just come off a 10% up month and the bulls are super strong. But this video could relate to any type of market that is going up a lot and you've experienced a lot of gains with the shares that you own in a Roth IRA or a traditional IRA or in a margin account that you do the wheel strategy in. Now, when the market is going up and it's going up a lot, then that is the best time to start being vigilant about the downside because it will happen. 90+% of stocks go up when the market is going up, and 90+% of stocks go down when the market is going down. So when you have experienced a awesome run to the upside and you're feeling great about your portfolio and you think it's going to last into perpetuity, that is the time to take a step back and strongly consider the hedging process at that time. And if you're doing the wheel strategy, you can improve on it to help yourself to the downside. We call it here at the Dorian Trader the safeguard strategy, where we add two more strategies to what is commonly called the wheel strategy. The wheel strategy is when you sell a naked put with the premise of being okay with buying the shares if required if the stock drops below your strike price. And then if you are required to take ownership of the shares, then with the wheel strategy, you then start to sell a covered call. Selling a covered call is when you have at least 100 shares and then you sell a call against it. You have the shares, so that is why it's called a covered call. Now, the two strategies that's built around the wheel strategy is bullish, and you have just a little wiggle room for the market to drop and you still be okay, or a stock to drop and you still be okay. So the wheel strategy is better, in our opinion, at the Dorian Trader than just outright buying shares, because with the wheel strategy, you're always going to get it for a discount when you initiate that trade, and that's a good thing, right? That's a good thing. You're not buying at retail prices, right? You're getting wholesale prices. You're getting better pricing when you use the wheel strategy to get started. But at the Dorian Trader, we have made the wheel strategy better, and we call it the safeguard strategy. So we add a strategy called the collar strategy to the wheel process, and the collar strategy will help you more to the downside, and we'll show that here in a second. And then we've also added what we call the bionic bull strategy that gives you unlimited upside. So in the traditional wheel strategy process, you always have limited upside, and that's discouraging to some people who like the wheel strategy, but at times want unlimited, or at least the potential to have unlimited upside when you're going into a bull market, or it's in a bear market and things are falling a lot and you're thinking, okay, this is overdone, I'm going to start nibbling on the bull side, and you could potentially have a really significant up move when that's the case. So we have the bionic bull that gives you unlimited upside, and we'll show you here in a second. So on the screen here, you see the ExxonMobil option chain. And we're going to use the ExxonMobil option chain just for demonstration purposes, so you can understand how the wheel strategy works and how the safeguard strategy that we created at the Dorian Trader improves on the wheel strategy. So let's break down the four different strategies. There's two that's associated with the wheel strategy, and then the additional two that is a part of the safeguard strategy that we teach at the Dorian Trader. But before we do that, I want to point out that if you are finding value, or if you find value in this video, please like the video and subscribe to our channel if you haven't, and leave a comment. We answer all comments. And if you're interested in learning, we do free webinars almost every week. So go to our website, register for a webinar, and our webinars are not sales pitches. We literally teach about trading options. So check us out. With that said, when you're starting off with the wheel strategy, you sell a naked put initially. And so if we sold this naked put on ExxonMobil at the 100 strike here, we would collect about 236. Right? So it's jumping around, so I'm going to lock this here. We're going to collect about 236. and our cost basis would be just under $98 a share at 97.64 there. So instead of buying the shares right now at 101, you would get the shares at a cost basis of just under 98. And someone is going to pay you $236 for that right. And you will have a 65% chance of winning on the trade. So that's really awesome. This makes the wheel strategy important or promising because it's better than just outright buying the shares, because you're always, like we said earlier, you're always going to have it at a discount. So then if you have to take ownership of these shares, and I just say you had to take ownership of the shares, then you would do what is called a covered call. A covered call is when you have 100 shares, as we stated earlier, and then you sell a call against it. So in this case, you're selling the 105. And if you did that, or if you started with this process, what we recommend as well at the Dorian Trader, you don't have to always start with the naked put. You can start with the covered call. You start with this process, you're going to have a lower cost basis as well. Your cost basis is going to be just above $99 a share, and once again, it's trading at over 101 right now in this example here. And so the covered call can give you some cushion to the downside as well, but you have limited upside. The most you can make on this trade is $569, which is not bad, but it's not unlimited potential to the upside. So the covered call has a cap to the upside of what you can make, and you still have risk all the way to zero. Just like with the naked put, you still have risk all the way to zero if the stock you're doing the naked put or the covered call on goes out of business. Exxon it's the odds on Exxon going out of business is darn near zero. So the next strategy we want to discuss is what we call at the Dorian Trader the collar strategy. We have incorporated the collar strategy into what we call the safeguard strategy. So the collar strategy is when you sell a covered call, just like we just did, but this time you take some of the monies that you receive from the covered call and you buy a put to protect yourself to the downside. So in this example here, let's just say we decide we're going to buy this 97.5 put, this 97.5 strike put, and you can see that our risk is no longer all the way to zero. Our max loss now is only 338, but we still have a decent max profit at 411 here, and our probability of success is still decent, right? It's at least a coin flipping chance of winning on this within the next 45 days, as you can see here. So this is the collar strategy. Collar strategy protects you to the downside in this, the most out of all the four strategies that we teach at the Dorian Trader with this safeguard strategy. You cannot lose anymore after it goes past the 97.50, and you cannot win anymore after it goes above the 105, right? So this is called the collar strategy. If you want to learn more about it, we have a number of different videos that we go in more detail on our YouTube channel here. So jump in, dive in, learn as much as you possibly can, or you can come to our webinars or decide to join the Dorian Trader. We can teach you these things. The Dorian Trader, all of our members have access to their mic. It's not just a chat room environment for members. If you have a question, you can unmute your mic and interrupt the instructor, and we encourage that at the Dorian Trader. So check us out. All right, so with that said, we have the last strategy is what we call the Bionic Bull. And the Bionic Bull is when we sell a naked put. Let's say we sold this 100 strike put, and then we take some of those monies and we buy a call. So in this example, if we wanted to take some of that 100 strike put amount, some of this 230 that we're receiving, and buy this call at the 105, we're going to get a credit of $50 to $51, and we would have unlimited upside. As you can see, max profit is undefined because we have unlimited upside. We will still be getting the shares at a discount to the current price at just under $100 at 99.46, and the current price is at 101, as we stated and been kind of demonstrating here. So this is the Bionic Bull. You still want to take ownership, just like all the other three strategies we talk about here. You want to take ownership of the shares. You're okay with taking ownership. The premise is that you're okay with taking ownership. But with the collar strategy, you limit your downside, and with the Bionic Bull strategy that we have here, you have unlimited upside. So your upside is not defined. So these are the strategies that we teach at the Dorian Trader for the safeguard strategy. And if you are going through this bull market, or you're going through a bull market at the time you watch this video, we encourage you to be vigilant. This is the best time to start looking to protect yourself. And if you're doing the wheel strategy in an IRA account, or if you're doing it in a margin account, then this is the time to protect yourself and learn the safeguard strategy. If you have any questions, leave them in the comment area. We appreciate you watching this video. We thank you for watching it. We'll see you next time. Bye for now.